Hello and welcome to Module 1 of Making Money with Forex, in which we look at the background to trading and spread betting Forex. My name's Jeff Fitzpatrick, your tutor for the module. In this module we cover the basics. We explain what buy and sell trades are. We begin to understand spread betting and how that compares to Forex trading. We look at what currency pairs are and which one to trade. We look at the trading hours available to us and which ones are best to trade in. And we start to look at charts and candlesticks and something called indicators, as these will go on to give us entry and exit signals from which we can trade. Before we start working on this module, it's important that you understand that there is risk involved in spread betting and Forex trading. Therefore, I would like you to read the risk disclaimer that's shown and to accept and understand it before we progress. So let's get straight into it. Everyone is familiar with buying currency for a foreign holiday, and they're usually fine with the idea that this involves using one currency, usually the UK pound, to buy another. It could be euros, Turkish lira or anything else. And when we go to the travel agent or the bank to exchange our money, we get an exchange rate which tells us how much of the other currency we get for each pound that we hand across. Well, imagine coming back from your holiday with some foreign currency left over. And also imagine if while you're away the exchange rate had moved significantly against the pound. You'd then be able to go back to your travel agent or bank and hand your spare foreign currency across that you brought with you for more pounds than it took to buy each unit of foreign currency before you left. That's exactly what happens in a Forex buy trade. We buy some currency, wait for the exchange rate to move in our favour, and then sell it back at a profit. However, significantly, we don't need to go to the bank or travel agent to undertake transactions. We only need the exchange rate to move a tiny fraction in our favour for us to make a profit, and we can control the time scale. We can wait a few moments or as long as we like for the trade to move in our favour. This will become very clear as we move forward. So let's look at sell trades. Buy trades were fairly straightforward, but sell trades are slightly different. How can we sell a foreign currency that we don't already own? Is that dangerous thing called going short or short selling? Well, if we were actually trading currency, the answer to both of these questions would be yes, and it would involve serious risk. However, in spread betting, we have a risk still, but a far more controlled and understandable risk. Again, this will become clear as we move forward. However, let's clarify a little. We're not actually going to trade currency at all. We are going to bet. We're going to bet on whether the exchange rate of a currency is going to move up or down. Confusingly, placing a bet on an exchange rate going up is called a buy trade, and betting that a trade will go down is called a sell trade. And even more confusingly, these are often referred to as going long or going short. So as mentioned previously, we're going to be involved with spread betting rather than actually trading currency, buying and selling it, or Forex trading. Perhaps you can already see an advantage in betting over trading. It's simpler and it's just easier to understand. Spread betting has a further major advantage of not attracting tax for most UK taxpayers. The next early confusion to clear up is in respect of ask, also called the offer and the bid prices. Currencies are always quoted in two prices. After all, when you buy currency to go on holiday, you use one currency to buy another. It is easy to remember that we, the poor punter, are always worse off. So if we enter a buy trade, we get the higher of the two prices that are always quoted, and if we enter a sell trade, we get the lower of the two prices quoted. The ask and bid prices are so called because from the broker's perspective, the higher price is what they are asking for somebody to pay to buy from the broker, and the lower price is what they would bid to somebody else to sell to the broker. Each currency is known by a letter symbol. The pound sign, which we're all familiar with, is for the GBP, the Great British Pound, for example, and the US dollar is known in trading as the USD. The euro is the EUR, and so forth. By its nature, an exchange rate has to involve two currencies, and these are known as pairs. A pair is known by both symbols, so the GBP USD, for example, is the UK pound and the US dollar pair. This is also known as cable. The first symbol, in this case GBP, is always the base currency in the exchange rate. So a rate of 1.5734 means that £1 would buy $1.5734. There are lots of currency pairs, but the main ones involve the UK pound, the US dollar, the euro, the Swiss franc, the Australian dollar, the New Zealand dollar, the Canadian dollar, and the Japanese yen. Each pair has different characteristics, such as the volume of money traded, the volatility levels, etc. It is better to know your chosen pair well and to have a reasonable trading volume and reasonable volatility. On this basis, I trade and only trade the GBP USD, so the pound-dollar pair known as cable. Unlike the stock market, the Forex market is open around the clock. It opens at 2200 hours UK time on a Sunday night and is open through to 2200 UK time on Friday night. There are very few holidays. However, sometimes when it's a public holiday in London or New York, for example, or in Europe, the market can be very quiet, making trading more difficult. It is easier to trade when the volume, that's the number of trades, is larger rather than smaller. It's probably best to trade between 7 in the morning and 5 in the afternoon in the UK. Irrespective of whether it's British summertime or not, those are the best times to trade between. It is certainly possible to trade outside of that period, but better again, if you can, to trade within it. It is also possible to set trades to trigger automatically, whether opening or closing, when you're not available to look after them. I would now like to introduce the subject of charts. And charts is just a name for graphs that traders tend to use. It's the main tool used by traders in spread betting or basically any type of stock market or currency trading. Charts record price movements of a particular currency pair over a given time period. The next slide shows a chart for the Great British Pound US dollar currency pair. The line joins together the closing price, that is the exchange rate, at the end of every minute. Notice that the time interval of the chart is 1 minute, pointed to that with an arrow. You can also see the exchange rate shown on the right hand side, and also the second arrow from exchange rate indicates on the chart where that price is. You can also see two horizontal lines. They represent the bid and the ask prices. And along the very bottom of the chart you can see that the volume bars are displayed. They're showing the number of trades per minute being traded on this particular currency pair. The line graph or chart shown on the previous slide is very useful. However, another type of chart known as a candlestick chart is more useful to traders because it tells us more about what is happening with the exchange rate price. However, first we must understand what the candlesticks themselves in the chart represent. This slide shows a pair of candlesticks, one black and one white. Quite often there may be other colours. It's regularly the case that a bear candle, a down candle, is red also, and a bull or up candle is green. So looking at each of the two candlesticks, we can see that there's a main body, that's the black solid area or the white solid area, and that they each have a pair of wicks, one above and one below. So if you can see at the top of, for example, the black-bodied candlestick, the solid area, that would represent the opening price. At the bottom of the solid area, that would be the closing price of that particular period. The period could be a minute, a day, a month, a year, or any other period. However, the two wicks represent prices at which this particular currency pair has traded during that period. So this particular candle opened at the top of the dark area, closed at the bottom of the solid dark area, but during the period it closed at the very highest point where it says high, and also at the very lowest point where it says low. The candlesticks do vary quite a lot. So for example, sometimes there may be no wicks involved, or there may just be a wick at the top or the bottom. Here is a chart showing lots of candlesticks. The green ones are upward price movements and the red ones are downward price movements. The timescale doesn't matter. The chart could look exactly the same whether we're looking at a month or a minute. When you looked at the last slide, you probably already began to see a pattern emerging, a trend in the prices. They're either rising or falling in several sections of that diagram. Whenever possible, we want to place our bets in line with the prevailing trend of the price movement. It's sometimes more memorable to be remembered as, let the trend be your friend. Thankfully, prices can only trend in either an upwards, downwards, or straight across direction. That should make life easier for us. Looking at the candlestick chart again, can you see any trends? Hopefully your eye is picking up the trends on this chart. The main trend is shown by the long blue arrow, and it's downward. However, within that, there can be shorter period trends of upward or downward movements. And this is the case irrespective of what time period the chart is showing. Here is a 1 minute chart, and as you can see, the prevailing trend is definitely down. However, if you were to just look at particular sections of this chart, you could be forgiven for thinking that it was in an upward trend. So there are sub-trends within the major movements. This candlestick chart is a 5 minute chart and basically covers the same period. You'll see that the trend is very different. In fact, it's an upward trend. Now, although at the moment this is a bit confusing, it's actually going to be something which is very, very helpful to us later in the program. It's really going to help us to make some decisions about entering and exiting trades. So for the moment, just take it on board and think of it as good news. The fact that looking at a chart with a 1 minute time interval can be completely different in terms of trend with that of a 5 minute chart is very important. It is central to the Raven-Glen method of selecting trade and entry and exit points. You will see that the trend picture varies just as much between other time intervals, such as the 15 minute and the 30 minute chart, or the 1 hour, the 4 hour, the 1 day, or the month, or even over years. Again, look at as many charts as possible and train your eye to pick out the different trends and notice the difference when viewed in different time periods. Trends are obviously very important to trading, and over the years many traders have developed particular ways of looking at trends in an attempt to determine whether they are going to continue or change direction. These are usually referred to as indicators, and indicators are represented on charts as lines or symbols, and they assist in the decision-making process in respect of opening or closing trades to maximum advantage. There are many different indicators available, and different traders use different indicators with varying degrees of confidence in them. For example, the simple moving average is a popular indicator used by many traders. The simple moving average is a fairly simple concept. So for example, if we were looking at a 20 period moving average, perhaps each one of those being a month, come a new month we would knock off the first month from the 20 and add on a new one to the end, so we still had 20 periods, and then would take an average of them. Traders use lots of different periods in their moving average. It could be 20 periods or 250 or 10, and this would be applied to different time intervals. So it could be 10 minutes, 10 5-minute periods, 10 15-minute periods, or 10 200-minute periods. The most popular ones tend to be the 20, 50 and 200 moving average periods, applied to particularly the hour. As you progress through the program, you'll see that indicators and trends are increasingly important. They are the things that give us indications of when a trend is going to change direction or perhaps continue in the same direction. These give us entry points and exit points for opening and closing trades, and therefore you can see they're extremely important. And they will come up in each of the modules as we move forward. And that brings us to the end of Module 1. Coming up in Module 2, We'll look at opening an account, a GKFX spread betting account, setting up the trading platform, changing colour scheme and preferences, installing Bollinger Bands and setting up trading records. See you in Module 2.